Welcome to the deep dive. Today we're tackling something really central to finance, auditing.
Yeah, it's fundamental. We've got a good source here, auditing, a practical approach.
Right. And we'll be digging into, well, everything. Internal controls.
Sales, receivables, purchases, payroll, the specifics.
Plus the general ideas, gathering evidence. Think of it as getting a real handle on how financial info gets checked.
Exactly. And we're not just skimming. We'll use examples, like that ongoing Cloud9 case from the source.
Ah, yes, the Cloud9 scenario. Good way to see it apply.
The aim for you, the learner, is a solid grasp of what an audit actually is. We'll pull out the key ideas, maybe some interesting bits on fraud.
But keep it understandable. No getting lost in technical weeds.
Right. We want those aha moments.
Okay, let's unpack this then. One of the first big points in the book is this difference. The preparer versus the auditor. Why draw that line so clearly?
It's, well, foundational. You've got the company's management, the preparers. Their job is fair presentation, making the financial statements look right, and having good internal controls.
So they're basically saying, here's our story, and we've got systems to ensure it's reasonably accurate.
Precisely. Then you bring in the auditor. They have to be independent.
Not working for the company.
Right. Their role. Form an unbiased opinion on whether those statements are materially misstated.
Oh, okay, unbiased. And to do that, they need, what's it called? Professional skepticism.
That's the one. Super important.
Meaning they can't just believe everything the company tells them.
Exactly. It's a questioning mindset. You critically evaluate the evidence you get.
So you're constantly verifying management's claims about assets, debts, how they're valued.
All of it. And the source also mentions the size of the audit firm. Small firms versus large ones.
Oh, right. Does that matter for independence?
Can. Smaller firms might have a large client that makes up, a big chunk of their fees. That could raise questions about independence.
Ah, I see. So the scale of a firm, like one of the big four, Deloitte, EY, KPMG, PwC, that actually helps.
In theory, yes, because no single client is likely to be so important. It compromises their judgment when auditing these huge corporations.
That makes sense. They dominate the audits of big public companies, right?
Pretty much globally, yeah. And they often drive the standards. It's a different level of scrutiny compared to what smaller firms might handle for, say, massive multinationals.
Got it. So we know who's who, but what is an audit fundamentally? And why should, regular people care?
Okay, at its core, an audit's objective is to give an opinion.
An opinion on
Whether the financial statements give a true and fair view, free from material misstatement, whether that's due to error or fraud.
material misstatement. So significant errors.
Yes, errors big enough to potentially influence someone's decisions. And why care? Because lots of people rely on this info.
Investors deciding to buy stock.
Lenders assessing credit risk, suppliers setting terms, all based on those financials being reliable.
So the audit provides a level of trust.
Kind of, yeah. But it's not foolproof. There's always audit risk.
Audit risk? What's that?
That's the risk the auditor gives a clean opinion, an unmodified one, when actually the statements are materially misstated.
Oops.
Yeah. And the risk of missing fraud is often seen as higher than missing simple errors.
Why is that?
Because fraud often involves deliberate hiding, collusion, fake documents, management overriding controls. It's designed to be concealed.
Right. The book mentions different types of opinions, too. It's not just pass or fail.
No, there's a spectrum. Unmodified is the clean one. But if there are big problems, the auditor issues a modified opinion.
Right.
Could be an adverse opinion, basically saying the statements are seriously misleading, or a disclaimer of opinion.
Disclaimer.
That means the auditor just couldn't get enough evidence to form an opinion at all. Maybe management blocked access or records were destroyed.
Wow. A disclaimer sounds like a huge warning sign.
It definitely is. Signals major uncertainty. And remember, audits aren't the only game in town. There's also review engagements.
Less assurance.
Limited assurance, yes. And compilation engagements, which is basically just formatting the numbers, no real checking.
Okay. And in Canada, there's a body overseeing the auditors of public companies, the CPAB.
Exactly, the Canadian Public Accountability Board. They register and inspect audit firms that audit public companies. It's about promoting high-quality audits.
So they audit the auditors, in a way.
Sort of, yeah. Checking their quality control, making sure they follow standards. It's crucial oversight.
And there's this audit expectation gap.
Ah, yes. That's the difference between what people think auditors do or should do and what they actually are responsible for. Communication is key there.
Definitely. Okay, let's shift to ethics and independence. This seems absolutely vital.
Couldn't be more important. If the auditor isn't ethical and independent, the whole process loses credibility.
So what are the core principles?
The source highlights several, but professional competence and confidentiality are big ones.
Competence meaning keep learning.
Yeah, staying up to date on rules, standards, business practices, it's ongoing. And confidentiality, keeping client info private unless legally required.
Got it. And independence. That's where it gets complicated, right?
Yeah.
Potential threats.
Absolutely. The book lists 5 main types of threats.
Okay, let's hear them.
There's self-review, like auditing work your own firm did previously. Self-interest, maybe having shares in the client or worrying too much about fees.
Okay.
Advocacy, promoting the client's shares, for example. Familiarity, getting too close to the client after many years. And intimidation.
Intimidation, like the client pressuring the auditor.
Exactly, trying to influence their judgment. All these can potentially cloud objectivity.
Yikes. So how do firms protect against these? What are the safeguards?
Firms have lots of policies and procedures. Training on ethics, client acceptance processes that check for threats early.
Makes sense.
Partner rotation on audits is common so relationships don't get too cozy. Peer reviews within the firm. And channels for staff to report concerns.
And the company's audit committee plays a part too.
A huge part. Ideally, it's made up of independent, non-executive directors who know finance.
So separate from management.
Yes. They oversee the whole financial reporting process, hire the external auditor, and are the main contact point for the auditor with the board. If there are disagreements with management, the auditor talks to the audit committee.
What about internal auditors? They work for the company, right?
They do.
Mm.
So they aren't independent in the same way as external auditors. But
Yep.
if the internal audit function is strong, objective, and competent, the external auditor might be able to use some of their work.
To be more efficient.
Potentially. But the external auditor is still fully responsible for the final opinion. They have to assess the internal auditor's work carefully if they rely on it.
Okay. So lots of checks and balances. But things can still go wrong. Can auditors be sued?
Oh, yes. Auditor liability is a major factor. They can be sued by their client if they're negligent, didn't exercise proper care, and the client suffers a loss.
And what about others, like investors or lenders?
That's more complex, usually no direct contract. They typically sue under tort law, needing to prove the auditor owed them a duty of care, breached it, and caused their loss. Landmark cases have shaped this area.
And it's not all on the auditor, right? Management has responsibilities too.
Absolutely fundamental. Management picks the accounting policies, prepares the statements fairly, sets up internal controls,
And gives the auditor access.
full access to people and information. It's a two-way street.
The book had some interesting ethical dilemma examples, like the CPA not wanting to do more training.
Yeah, that hits the competence point again. It's not a one-time certification. It's ongoing learning.
And the non-accountant spouse preparing statements.
Raises questions about quality, doesn't it?
Yeah.
Or offering free work with strings attached that screams independence threat.
Those examples really make the ethics part concrete.
They do. It's not just abstract rules.
Okay, so principles, players. Let's zoom out. The audit process itself, it starts with risk assessment.
Generally, yes. The risk assessment phase. It's about understanding the client, their business, their industry.
Can't audit what you don't understand.
Precisely. Identify the risks. What could go wrong? Where are errors most likely? What are the significant accounts?
Like using the Cloud9 case, knowing they import shoes helps pinpoint risks in inventory or receivables.
Exactly. Understanding the business context is key. This is also where you assess the risk of fraud.
Ah, the fraud triangle. Opportunity, rationalization, pressure.
That's a common framework, yes. Auditors look for conditions suggesting those elements might be present. They also consider going concern risk.
Whether the company can stay afloat.
Right. For the foreseeable future, usually the next year.
And IT systems.
So-
Hugely important now, I guess.
Critical. Understanding IT general controls like passwords, access rights, and specific application controls. They affect the reliability of all the electronic data.
And materiality gets set here, too.
Okay.
The threshold for errors.
Yes, planning materiality. Plus, developing the overall audit strategy and detailed plan. Again, the Cloud9 case shows what goes into that plan.
So risk assessment sets the map. Then, internal controls. We keep coming back to them.
Because they're the foundation for reliable reporting. They're the company's own systems to prevent or catch errors.
The book breaks them into 5 parts.
Yes, the control environment, the tone at the top,
Ethics, management's attitude. The Wells Fargo example highlights that.
big time. Then the company's own risk assessment process, the specific control activities, information and communication systems, and monitoring how well controls are working.
And there's a difference between broad, company-wide controls and specific ones.
Right. Entity-level controls, like a code of conduct, affect everything. Transaction-level controls are specific to processes, like needing approval for purchase orders.
Auditors focus more on the transaction level.
Often, yes, because they directly impact the numbers. But the entity level sets the context.
And controls can be preventative or detective. Stop errors or find them after.
Exactly. Segregation of duties is preventive. Bank reconciliations are detective. And don't forget, IT General controls ITGCs.
They underpin everything electronic.
Pretty much. If ITGCs are weak, the application controls might not be reliable.
So how do auditors pick which controls to actually test? Can't test them all.
No way. They focus on key controls, the ones most important for addressing the biggest risks efficiently.
And how is the testing done?
Various ways. Asking questions inquiry, watching people do things, observation, looking at documents inspection, doing it themselves reperformance.
And using test data for IT controls.
Yes, inputting dummy data to see if the system catches errors. Cloud9 shows testing controls over sales and cash receipts.
And then they document all this.
Yes, using narratives, flowcharts, checklists. They evaluate the results, do the controls work.
What if they find weaknesses?
They assess the impact on the audit plan might need more substantive testing. And significant weaknesses get reported to the audit committee, usually in a management letter with recommendations.
Okay, controls are step one. But auditors need their own evidence too, right? Beyond testing the company's controls.
Absolutely. They need sufficient, appropriate audit evidence to back up their opinion. This links back to audit assertions.
Assertions, management's claims about the financials.
Exactly. Claims about existence, does it really exist? Completeness, is everything recorded? Rights and obligations, does the company own it or owe it? Valuation, is it recorded at the right amount? And so on.
So evidence gathering is targeted at these assertions.
Correct. And some evidence is better than others.
More persuasive.
Yes. Evidence direct from an external source to the auditor is usually best, like a bank confirmation.
Makes sense. Less chance of manipulation.
Right. Evidence generated externally but held by the client is next best. Internally generated evidence is weakest on its own.
So external confirmations are a key type.
Definitely. Getting info straight from third parties, banks, customers confirming receivables, suppliers confirming payables.
Positive versus negative confirmations.
Positive asks for a reply, always. Negative only asks for a reply if it's wrong. Positive is generally stronger evidence. Electronic confirmations are common now too, but need careful controls.
What about just looking at the company's paperwork, invoices, contracts?
That's documentary evidence. Also crucial, auditors use tracing.
Following from source document to the books for completeness.
You got it. And vouching.
Going from the books back to the source document for existence or occurrence.
Exactly. Making sure recorded things actually happened. The Cloud9 case mentions using shipping documents after year-end to check receivables.
Legal letters, too, from the company's lawyers.
Yes, to get info on lawsuits, claims, potential liabilities that need disclosure.
And sometimes they need help from specialists, experts.
Right, for things like complex valuations or specialized inventory. Auditor needs to check the expert's competence and objectivity, though.
And it all gets documented in working papers.
Absolutely essential. The record of everything done, evidence found, conclusions reached, supports the audit opinion. There are permanent files and current year files. Cloud9 has an example for receivables confirmations.
Okay, evidence gathered. But they can't check every single item, especially in big companies. Sampling must come in.
It does. You test a portion to draw conclusions about the whole population, but there's always a risk.
Sampling risk. The sample might not be representative.
Correct. And non-sampling risk, making a mistake for other reasons, like using the wrong procedure or misinterpreting results.
Statistical versus non-statistical sampling is one better.
Statistical lets you mathematically measure sampling risk. Non-statistical relies more on judgment. Both are used. Non-statistical might even be more common in practice.
What decides the sample size? Bigger risk, bigger sample?
Generally, yes. Also depends on how much error you can tolerate, how much error you expect to find, and how confident you need to be. Lower tolerable error usually means larger sample.
And the goal is a representative sample, but it's never guaranteed.
Never 100% guaranteed. And finding no errors in a sample doesn't mean the whole population is error-free. You have to be careful. Consider things like Cloud9's new store opening, different conditions, might need different sampling.
And sampling applies to testing controls and testing the actual numbers.
Yes, but the objectives differ. Control testing checks if controls work. Substantive testing looks for dollar misstatements in the accounts.
Okay, so sampling helps manage the volume,
Yeah.
but then comes the deep dive into the numbers, substantive procedures.
Right. These are designed specifically to detect material misstatements in the financial statement amounts themselves.
And the amount of substantive testing depends on the risk assessment.
Directly. High inherent and control risk means you need low detection risk, which means more substantive testing. Nature, timing, extent all depend on the assessed risks.
What kinds of substantive procedures are there?
Two main types. Tests of details, verifying balances and transactions directly. That's your vouching and tracing again.
Okay. And the other type?
Substantive analytical procedures, looking for plausible relationships in the data.
Trend analysis, ratio analysis, comparing financial and non-financial data.
Exactly. Like comparing sales growth to industry trends or payroll expense to number of employees can highlight areas needing more detailed testing.
And timing matters, doing work before year-end versus right at year-end.
Yes, some procedures can be done interim for efficiency, but key balances usually need testing closer to or after the year-end date. The goal is always to respond to the assessed risks for each assertion.
Okay, let's get specific. Auditing different accounts, sales and receivables. What's key there?
Big focus on occurrence. Did the sale actually happen? Completeness, are all sales recorded? Accuracy, cutoff right period.
Controls are important here. Sales orders, shipping, invoicing.
Very. Auditors look at those controls. Point of sale fraud is also a risk. Cutoff testing around year-end is crucial.
And confirming receivables with customers?
A primary procedure for existence and valuation. Also need to look at the allowance for doubtful accounts. Is it reasonable? The VVTT case shows control issues in revenue.
Okay. What about purchases, payables, and payroll?
For payables, completeness is often the biggest risk. Did they record everything they owe?
So searching for unrecorded liabilities is key.
Definitely. Looking at payments made after year-end unpaid invoices. Confirming balances with suppliers can also help. Controls over purchasing are examined.
And payroll.
Risk of fake employees or incorrect rates. Controls around hiring, firing, and rate changes are important. The Greystone Co. case highlights purchasing system flaws.
Inventory next. Often tricky. High volume valuation issues.
Can be very tricky. Existence is key, hence the auditor observing the physical inventory count.
They watch the company count its stock.
Yes, observe procedures, do test counts. Also need to check ownership, rights, and valuation cost versus net realizable value. Obsolescence is a risk. Siegel & Co. case brings up materiality for inventory errors.
Property, plant and equipment, PP&E. Long-term assets.
Focus on existence again, ownership, and valuation, including depreciation. Big thing is distinguishing capital additions from repairs expense.
So checking if spending improved the asset or just maintained it.
Exactly. Auditors test additions, disposals, repairs. Review depreciation methods and calculations. Look at leases. Cloud9 focused on existence and valuation here.
Lastly, cash and investments. High fraud risk with cash.
Often perceived that way. Cash is tempting. Existence and completeness are key. Risk of lapping, stealing customer payments and covering it up with later payments.
How do they audit cash?
Bank confirmation sent directly to the bank. Reconciling the bank statements to the company's books. Auditing petty cash.
And investments.
Verifying existence, ownership, valuation, especially fair value for many investments. Confirming holdings with brokers. The Stella's Stars case had a client resisting bank confirmations. That's a red flag.
Wow, that's a really detailed tour through the audit process and specific accounts. You see how much goes into it.
It's comprehensive. We've gone from ethics and independence, through risk assessment controls, evidence gathering, sampling, right down to testing individual balances. Hopefully that gives a clear picture of the auditor's role.
Yeah, ensuring that financial information is, reliable for everyone who uses it.
That's the goal.
So here's a final thought, something the source just touches on. This rise of non-financial reporting, ESG, carbon emissions, sustainability.
Right. It's becoming much more prominent.
But assurance on that stuff, getting it independently checked, is mostly voluntary right now, isn't it?
Largely, yes. Unlike financial statement audits for public companies.
So thinking ahead, as stakeholders demand more of this non-financial info, what does that mean? For transparency, for the future of assurance providers, like auditors, could their role expand significantly?
That's a really interesting question. The skills are transferable, but the standards are still evolving. It's definitely something to watch.
Absolutely. Well, this has been a fascinating deep dive. What parts stood out most to you? The learner, fraud detection, IT controls. Let us know what you'd like to explore next time.
Yeah, the world of auditing keeps changing. Technology, regulation, always more to discuss.